Good afternoon, colleagues. Good afternoon, learners. I am Kwanazi from the Subject Advisor of Accounting from Thabo Mofokeng District. And we are going to deal today with the financial statements. The first statement that we'll be treating today will be the income statement. Where we say the income statement, in this statement, we calculate the net profit or the loss of a business in a particular period, which is the financial period. And this information that we use to draw the income statement will be from the nominal account section of the trial balance. In most cases, but at some stages, it cannot be given in a trial balance where the sections will be divided. Like we know in the trial balance, we have the balance sheet account section and the nominal account section. So if the trial balance is not given according to sections, usually what has been done is the balance sheet account section will be grouped almost together at the top, and then the bottom ones will be the nominal accounts. But it is also important for the learner to know how to classify all the accounts. The learner should be able to classify, to know the assets account, the expenses, the income, the liabilities, and the owner's equity account, even if they are not being classified in the trial balance. Then the financial statements are being prepared according to the set of rules which guides the accountant in financial reporting, that is the Gr.12 principle. We know the Gr.12 principle, but what we need to know also is what is the aim of this Gr.12 principle? It is to ensure that the financial information is accurate, reliable, and relevant, and to ensure that financial statements are recorded in a consistent, uniform, and meaningful manner for every person who would be interested in those financial statements. He has to understand and he has to be given the accurate and the relevant information that will make him to make whatever decision that he wants. Who are these people who may be interested? The people who are interested, those that need the financial information, are the investors to determine how well is investment doing, the financial institution to determine the capacity of the business to repay them with interest, the creditors to determine whether they will be paid, the employees to judge fairness of salaries and to assess job stability, trade unions to set lower or upper limits in the wage negotiations. I'm just rushing through everything because I know this is what we have done. It is just to remind you why we have to do the financial statements. Then, with the Gr.12 concepts that we are talking about, we will be talking about the matching principle, which says the income and expenses should be recognized and recorded in the correct time. If we have the income during this financial period, this 12 months, it must be recorded and recognized at this right time. Even if we can receive the money for next financial period during this year, it has to be subtracted because of this matching principle. I think this is the one that is most applicable in the income statement as we are preparing that. It is because of the matching principle that we have to do all the adjustment. Then we have the historical principle, where we say the assets should be valued at the amount that was originally paid for. We will realize at this stage that when we do the depreciation, there is when we have to calculate the depreciation on the cost price. Then we have the going concern, where the financial statements should be prepared based on the assumption that the business will operate in future. We know the aim of each and every businessman is to make profit, and we have made investment if you open a business. And under no circumstances you'll find a businessman saying that maybe after next year I will have to close this business. So everything that has been prepared, the financial statements are prepared on the basis that the business will still operate in future. Then we have the prudence concept that says expected income with this one is not considered, but the expected loss is provided for. Even if we can be able to recover the expense of the loss, but we do not consider it. The only thing that counts is the expected loss that we make provision for. Then we also have the materiality principle, where we say all the significant information must be included in the financial information. This is the information that has to be shown, that has to be included, because this information somehow, if it is not included there, it may somehow influence the decision maker in one way or the other. Then the other one will be the business entity, which says business functions as a separate financial entity from its owner. So with accounting, we separate the owner with the financial concerns of the business. So they are two separate entities. For today, I would like us to have a look at the paper, of which I think most of us are acquainted with. That is how the question is going to be asked in the examination. Remember, I am not an examiner. I am just an advisor to say this is how, after observing for a number of times how the question paper is being said. So this is how we have discovered that these are the questions, the possible questions. With the income statement, this is one of the most simple topics that we have in accounting, where learners must always accumulate most of the marks. And firstly, the learner must understand the format. If you can understand the format of the statement or the framework, like they say, when you talk to the learners, you'll hear them saying that, no, that one we can see. Then if you ask them sing it, then he will be telling you all the details of the income statement like that. Then that is the bold learners who knows this stuff. Then this question of the income statement, like I have said, it is one form of the financial statement. The other one can be the balance sheet, but today we are talking about the income statement. It's either the question paper requests you to do the income statement or the balance sheet, and the balance sheet will be done on other days by some of my colleagues. But for today, we concentrate on the income statement. And these financial statements are not just financial statement, but are the financial statement with the notes. That is very important. We need the notes, because the notes, they do explain a lot of how the amount was arrived at. So the question paper that I have in front of me, it's testing the company concept, the fixed asset, and the financial statement. As you can see, it carries almost 80 marks. Remember, this question falls under that category, which we said at the beginning, that it carries almost 150 marks of the question paper. So for this financial statement, it is allocated 80 marks. Then question 1, choose a gap principle from column B to match the description in column A. Write only A to D next to the question number 3.1.1 to 3.1.4 in the answer sheet. You will be provided with an answer sheet that will look like this, where you will be expected to give your answers, the correct answers, when responding to the questions. Let us treat the questions now that we have already summarized what the gap principle or the concepts are. The first one says, in preparing financial statements, assets are recorded at the amount that was originally paid. So if it was original, that means it's historical. So the correct answer in that instance will be C. Then the expenses and income must be recorded in the appropriate financial period. we match the expense with the period. That will be the matching concept, and the correct answer will be A. 3.1.3. In preparing the financial statements, the accountant will assume that the business will continue. If it continues, it means it is still going on. This one was very, very clear. I think everyone has got it correct. And that will be D. And 3.1.4, any amount which is significant to the decisions made by the reader of the financial statement should be disclosed separately in the financial statements. That is the materiality concept. Then that's how we match the column A to column B. You read the explanation on column A, you match it with the concept. But if you haven't studied the concept, it's going to be very difficult. Even if when I was answering, it seemed as if it was easy. But if you didn't practice that before, you didn't study that before, then it's going to be very difficult for you. So as we are studying, please also read and understand the concept. Then let us go to 3.2, which says you are provided with the information related to Global Ltd on the 28th of February 2013. This is our financial period. Global Ltd has authorized share capital of 600,000 shares of R2 each. You are required to complete the fixed or the tangible asset note on the 28th of February 2013 for 18 marks. Complete the income statement for the year ended the 28th of February 2013 for 45 marks. And prepare the retained income note on the 28th of February 2013. May I clearly state that with the income statement, not all the notes will be asked at one stage, but few notes can be picked up so that you complete or you prepare the note. What is important for the learner is to understand all the notes for the financial statement. So it's going to be easier to prepare the financial statement if the learner can be able to prepare the note. We are provided with the pre-adjustment trial balance as at the 28th February 2013. Fortunately, this one, the section has been divided. We have the balance sheet account section, we have the nominal account section. And remember, I said it is we are going to use the nominal account section to prepare the income statement. So for the income statement, we will use the bottom section, and for the balance sheet, it clearly says the balance sheet account. So these are all the accounts that has to be in the balance sheet. So let us concentrate on the nominal account section to prepare the income statement, and then also we are given the adjustment. But instruction 1, 3.2.1 says you first have to complete the tangible asset note on the 28th of February 2013. Let me say, I will do everything simultaneously because I wouldn't have time to go back to prepare the income statement or the tangible asset. But as I go along, I come across an adjustment, I will take the whole information, respond to it accordingly, and then pass to the other one. So that when I'm through with one adjustment, then I'm through with everything. The answer sheet that you would be provided with, the answer book. At one stage, there are these pages that are written, leave this page blank. May I encourage you to use these pages for your calculations. The only important thing is to indicate to the marker which question or which calculations were you doing. You would indicate that it's question 3, And what were you doing? If you were calculating depreciation, you will indicate I was calculating depreciation. You will clarify what you were doing on that page. So this page, I would like to see the calculations for almost every question that you would have attempted. Make use of it. Then, let us carry on with what we are supposed to do. Complete the fixed asset note for on the 28th of February 2013. We are given the financial period, and what we know is that the financial period equals to 12 months. If things were normal, we would have received or we would have paid everything for 12 months. But it doesn't go that way always. Sometimes we run short of a certain amount. Sometimes we pay before the actual date. So it is very important to have our financial period. I usually do it like this because I will make use of it for a number of times and I won't forget my countings. If it has ended on the 28th of February, it means it started on we need to count backward for 12 months. Before February, it was January 2013, and then it was December 2012, and then November, October, September, August, July, June, it's May, April. This count 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. So this is our financial period. So remember when I arrived here, I said December 2012. I'm counting backwards. So it will be March 2012. This is how we make the 12 months. Then let us get this information. For whatever date that would be given in the adjustment from March to January or to February 2013, whatever date will be mentioned up to this point, that means the information for that one will be added. It is at the right time, the matching principles say. And then for whatever we have beyond February, it has to be subtracted because it will be for the next financial period. According to the matching principle, I'm not expected to have that amount during this current financial period. Then let us go to the questions. Now that we have our timeline or our financial period, we are going to prepare the note to the financial statement with the information that we are provided with, the adjustments. In the adjustment, the first adjustment, the depreciation on vehicle is calculated at 30% per annum on the diminishing balance method. Take into account that a new vehicle with a cost price of 133,000 Rand was bought on the 1st of November 2012 and was correctly recorded. That means included in the vehicle balance, the 133 was recorded. So for us to arrive at, for the trial balance to reveal 513, it simply means the 133 was already included. Then let us capture that information. First, it has been captured. It says the additions is 133 when during the year. That was in November. But before November, How much was the vehicle? According to the pre-adjustment trial balance is 513,000. Then that is at the end of the financial period. Then this cost will be at this stage. We will be here. We have 530. So this is the information because it says it was correctly recorded. That's why we have at the end of the financial period, the cost is 513. So we have to subtract the 533,000 and the cost at the beginning of the year will be 380,000. Just an easy calculation. Right? Then the information that we are given, it says, you have to depreciate the vehicle at 30% on the diminishing balance. From this information, it shows we have more than one vehicle because this 133 is an additional one. And I think, remember we said the reason we are doing the revisions is for every learner to get all the simple marks. So the easier mark will be this one, where we will be calculating the first depreciation for this vehicle that is new. We calculate the depreciation for the new vehicle. The information says it was bought on the 1st of November. Then let us look at our timeline. Our financial period ends here. It says on the 1st of November, we purchased a new vehicle for 133,000. For how many months have we used this vehicle? It's for November, December, January, and February, which is 4 months out of the 12. We have used it for 4 months out of the 12. Then, according to the information in the question paper, it says it must depreciate at 30%, which is 30 over 100 on the cost price, because at this stage it's a new vehicle. It was never used before then. So we multiply that by 30%, and then for the only 4 months that we have used the vehicle, then according to the calculations, if I'm correct, I hope you are doing this with me. You'll correct me at the end. And if I'm correct, then I find 13,300. The 13,300 will be part of the depreciation. Remember, this one is for the new vehicle, And then also, we are going to need the information in the income statement. That's why I said to you, I'm going to do them simultaneously. So we have the depreciation. The first depreciation is for the new car which was purchased. And I'm still having the other cars, including the equipment that has to depreciate also. So with the new car, we have done the information. Then let us check with the old car that cost 380. How much is the depreciation? Remember, it must be on the diminishing balance method. Then according to the trial balance, the information that we are given is that accumulated depreciation on the vehicle is 178,600. On the diminishing balance, what is the formula? We say the cost price less the accumulated depreciation. So can we do that? The cost price, as we have found it, is 380,000. And the accumulated depreciation as given is 178,600. This is going to decrease the cost and the carrying value, which is the diminished balance, is 201,400. So we calculate the depreciation on the 201,400, which is 30%. And what we need to be aware of is that this vehicle has been used for the whole year. So as we are doing the calculation, we say the diminishing balance is 201,400. We multiply that by 30%, and we use that for the whole 12 months in the 12 months that we have in a year, which is the same as 1. But I just wanted to make you aware that we have used it for the whole year. Then we get 201,400. We multiply that by 30%. Then the amount that we are going to get is the depreciation. It's 60,420 according to this adding machine. That will be the depreciation for the new vehicle and the old vehicles that we have. So we add the two amounts, 13,300. The total depreciation on vehicles will be 73,720. Then we also have to show the depreciation for the new vehicle in the income statement. We said the amount is 60,420, and I cannot enter the amount here because I still have to calculate the depreciation for the equipment. Remember that the equipment also has to depreciate. So I'm still going to calculate the depreciation on equipment. This one is the depreciation on a vehicle. This is the new vehicle, and this is the old vehicle. This is how I will reveal it in my answer book. This is the script that is going to go along with my answer book. Remember, it is in the answer book, so I would have to show the calculations like that. Right, the second one, the second transaction, or let me finish the first adjustment, complete everything on the first adjustment. We have the carrying value of 201,400. We add for the vehicle 133,000. There was addition set cost. And then we subtract the depreciation at 73,720. And the carrying value is 260,680, if that is correct. Then the accumulated depreciation plus the accumulated depreciation should make the accumulated depreciation at the end of the year. That is, the accumulated depreciation at the beginning plus depreciation during the year will make the total for the accumulated depreciation at the end of the year. So 178,600 plus 73,720, that will make 252,320. And if you subtract 252,320 from 513,000, then you get 260,680. Then we are through with the vehicles. We continue with the second adjustment. The second adjustment being the trial balance reflects a figure of 3,100 in respect of equipment sold. So this relates to a computer which was sold for 3,100 cash on the 31st of October 2012. We sold equipment. Where's my financial year? We sold it in October, when the 31st. So it means we have used it from March until the 31st of October. That was when we used the equipment. Because on the 31st we sold it. So for how many months have we used it? 1, 2, 3, 4, 5, 6, 7, 8. If we are supposed to calculate the depreciation, then we know that we have to calculate it for 8 months out of the whole 12 months. No other entries in respect of this sale have been made. That means with the information that you are provided in the income statement, the adjustment was not taken into account. Now we have to take everything into account. The cost price of the computer was 6,000 and the book value at the date of sale was 2,700. This time we are not expected to calculate the depreciation, but we are supposed to check whether the information, to show how the information would be recorded. We need to reveal the correct information. Let us prepare the one and only account that will determine, that will show us how we can be able to record the transaction in the asset disposal account. Then the cost of the equipment, it says the cost is 6,000. The cost is 6,000 and the book value to date of sale. So the moment they talk of the book value, they are talking the carrying value, and there's no need for me to calculate the carrying value, but just to check in the answer sheet that I have, it's already given. The carrying value, that is the book value, is 2,700. So that was a free mark also. The information that we are given is that it was sold for cash. It was sold for cash. So if it was sold for cash, we say in the bank we have received 3,100. Then we have the accumulated depreciation. If it was, we were supposed to calculate it. But immediately it says it was sold at 3,100 and the carrying value is 2,700. That tells you that we have received an extra 400. We are supposed to get 2,700, remember. Because if they say the carrying value, remember we said the carrying value equals to the cost price less the accumulated depreciation. So it says the carrying value is 2,700, the cost price is 6,000. Then how much is the accumulated depreciation? That means it is 3,300. 6,000 minus 2,700, then the accumulated depreciation is 3,300. Then the total for this account will make 6,400. That means we have an extra 400. Is it a loss? Is it a profit? We have a profit because we are going to enter it. We open the profit on sale of asset account, which is a nominal account, and a nominal account which is credited, it is an income. It is an income. Then in the income statement, we are going to indicate the profit on sale of asset. It's 400 rand. That is for the equipment that was sold. The next information, depreciation on equipment is calculated to be 35,040 after taking all of the above into account. So this time we are not expected to calculate the depreciation, but we are given it is 35,040. It's given, and also in the answer sheet where it is filled in. So what we are supposed to do is now to determine the cost at the beginning so that we can also calculate the cost at the end. From the balance sheet, the trial balance that we are given, it says the equipment, it was 235,600. That is at the beginning of the year. Before taking, remember the adjustment says, let us read the information. No entries in respect of this sale have been made. That means what we see here, the sale of the asset is not there. So we have to take it now into consideration. Then the equipment is 235,600. The accumulated depreciation as in the trial balance, it's 73,940. We have to subtract it, 235,600 minus 73,940. Then we get 161,660, which is the carrying value at the beginning of the year. We don't have any additions. We have the disposal at carrying value. It must be subtracted. So we subtract it from 2,700. We have the depreciation that has to be subtracted at 35,040. Then the total carrying value at the end of the year is 123,920. Then let us complete that note, the cost at the end now. How much is the cost at the end? If I was supposed to do the equipment account, I would be having the equipment, balance of the equipment, and the asset disposal. Remember, it has to be subtracted, which is 6,000. So the 6,000 will have to be subtracted. It has been sold. We no longer have it in the business. So from 235,600, we subtract the 6,000, and we are left with the equipment of 229,600. No new equipment was purchased. Then we have the accumulated depreciation. In the accumulated depreciation, the account for the accumulated depreciation, the balance at the beginning of the year, the balance that we are given at the beginning of the year, which is 73,940, included the balance, the depreciation on the equipment that has been sold. The 73,940 include the amount that we have calculated as we were doing the asset disposal account. This 3,300. This 3,300 is included. The 3,300 is included in this. And now that we have sold the asset, we need to subtract the 3,300 because the asset is no longer with us. So the 73,940, we subtract the 3,300 for the disposed asset, and then we calculated for the remaining, we were given that as calculated it is 35,000. So we add also 35,040 and the total amount will be 105,680,000. This is for the depreciation. So if we subtract from the cost at the end of 229,600, we subtract the depreciation for 105,680, we will get 123,920. Okay, let us have a look at this information. This amount is from the pre-adjustment trial balance. This information is from additional information. And the last part is the post-adjustment. After taking into account the adjustment, then we have this information. Before taking into account, we have this one. So I'm not expecting to hear that learners don't understand how to do this note, because you will be given either this part or that part. And in this case, given this part for the vehicle and we are given that part. I think this activity is a very good one for a learner to understand how to go about if he's given the pre-adjustment trial balance and if he's given the post-adjustment trial balance information, how to deal with it. So this one, at least it has exposed us a lot. We have the pre-adjustment, the top part, post-adjustment, the bottom part, the additional information there. So every information that will be given for the movements, the depreciation, you enter it here. Do the calculations, remember, separately. You first do the new one and you do the remaining one. You do the disposed one and you do the remaining ones. Then in that way, you'll get your stuff correct. Then this information, the 35,040, we were given, but it's not been entered into the income statement. So in the income statement, we will also have to include the 35,040 that we were given for the equipment, plus the 3,300 for the disposed equipment. We add the two, then we have 35,040 plus 3,300 plus 13,300 plus 60,420. The total for the depreciation is 112,060. So we have done the depreciation and I have completed the fixed asset, but at the same time I have done the income statement. That's why I said I'm going to do them simultaneously, because with the same information I was able to complete the two. So it is also advisable for you also to do both. But it goes along with practice. We have to practice and practice and practice and you'll be able to do it. But it's a very easy one, because with the income statement we have started doing the income statement as early as grade 10. Then let us continue to the next adjustment. The next adjustment interest is capitalized on the mortgage loan. The annual statement from Pride Bank reflected the following. The balance on the 1st of March is 304. We don't know how much is the interest capitalized for the year. The repayments, including interest, for the whole 12 months is 78,000, and at the end, we get that the loan is 288,700. Then the interest is capitalized. We have to calculate the interest on loan. Let us calculate the interest. We have the balance. The only unknown is the interest capitalized. So we have the balance, which is 288,700. We add. We're going up. We're using the opposite sign. We add 78,000. And then we subtract 304,000. Then we've got 62,700. So the 62,700 will be for the interest expense. The interest expense just before the profit before tax. Because of its materiality, it has to be disclosed at the bottom of the income statement, not on the face of the income statement. 62,700. It is an expense. We have to show it as in bracket. It's a negative amount. It's going to decrease our net profit. We have to pay this interest, remember. Then D, the account of R. Kingful, who owes 1,520, must be written off. We need to write off 1,520. This Kingful has been included in the list of the debtors. His amount was here, but now he cannot pay, so we need to write it off. So we add him to the bad debts. Do we have the bad debts in the trial balance? Yes, we do have the bad debts for 1,350. We start with the trial balance amount, 1,350, plus the additional information, which says 1,520 has to be written off. Then adjust the provision for bad debts to 4% of the outstanding debts. We have the debtors control. This is the total of the debtors as 71,820. But out of 71,820, we said Kingful is not going to pay us 1,520. So we need to subtract that amount because it's no longer a debtor here. We talk about the outstanding debtors, the debtors that have not yet paid us, that we hope they will pay us, and that will be 70,300. So we are going to calculate 70,300. We calculate 4%. As it is been given that we need to calculate 4%, and the 4% equals 2,812. This is provision for bad debts. Provision for bad debts, we get it as 2,812. Now we have got 2,812. This amount will be taken to the note, to the financial statements. And to which note? That will be to the trade and other receivables. This note will be taken to the trade and other receivables. We are not going to use this amount in the income statement. What we need to do now is to compare this amount with the amount that we have in the trial balance, which is 3,800. We compare the two. The trial balance is bigger. The calculated it's less. So if the calculated is less, the trial balance being bigger, then we have to reduce the provision for bad debts. That means instead of having a loss, this time the provision for bad debts adjustment will be an income. Then we check the difference. is 3,800 minus 2,812, and the difference is 988. So for 988, we say we are going to have provision for bad debts as an income, provision for bad debts, adjustment. Please indicate it's adjustment, because if you have it as provision for bad debts, remember I said provision for bad debts is a note. It means you regard it as a balance sheet item, and it is a foreign item. It's not supposed to be in the income statement. Right, learners and colleagues, can we have a 10-minute break? Then we'll see each other after 10 minutes. Thank you.